You must have heard about the world-famous takeover of Twitter by billionaire entrepreneur Elon Musk. You are probably also aware of the drastic changes the maverick businessman had brought about in the social media company. But did you know that Musk, the world's richest man, had to liquidate his assets to fund his high-profile takeover? You would be shocked to know that even after sacking hundreds of employees, the balance sheet of Twitter isn't coming out of the red. And that if Musk's reckless misadventure fails, he could lose up to $100 billion and trigger a global economic meltdown. In this video, I will talk you through the fundamental process of this buyout and how it's flawed so that you can make your conclusion about the fate of the world economy. Let's get on it. Twitter has been generating international headlines ever since Elon Musk acquired the social media site, but its ad revenue is declining. Given that it accounts for 90% of Twitter's revenue, it's a major reason for concern. Some of the most well-known companies have suspended their Twitter advertising. Additionally, it appears that there aren't many customers for the $8 monthly blue tick. Employee management at the business has generated debate from the beginning. Elon even mentioned filing for bankruptcy because things had gotten so awful. But while the majority of us were paying attention to these shocking headlines, very few of us were paying attention to Elon Musk's brilliant financial plan to purchase Twitter. This is known as the leveraged buyout strategy. So, let's first take a closer look at it to try to understand what precisely it is, and what makes it so dangerous that it could harm the American and global economies. A leveraged buyout, LBO, is when one company tries to buy out another company by borrowing most of the money. The company that buys another one issues bonds that are backed by the combined assets of the two companies. This means that the assets of the company being bought out can be used as protection against it. At the beginning of the 2020s, this mainly aggressive or predatory behavior resurfaced from the past. You might be thinking, why do LBOs happen? Well, LBOs are often used to take a publicly traded company private or to sell off a piece of an existing business. The main benefit of a leveraged buyout is that the company buying it can buy a much bigger company by using only a small amount of its assets as protection. This lowers the risk for the buyer if the business they buy doesn't do well. Also, if it makes money, the buyer can get all the milk out. That sounds like a win-win deal. Musk's main reason for making this deal was to make Twitter private. Now that the acquiring company appears to be attempting to avoid the risk, the question that arises is why someone would want to be the lender of this kind of scenario. Well, there's a very straightforward answer. Because they charge such a large interest rate in this situation, the lender makes enormous profits. These loan rates may occasionally reach 15 to 20%. The debt installment could become so large as to push the business into bankruptcy. However, it's not as easy as it seems. Banks are aware of the extremely high risk involved in financing billions of dollars. The bank sells these loans as bonds in order to reduce this danger. These bonds are known as junk bonds because they carry a significant level of risk. The bank starts profiting on both ends in the form of interest from the borrower as well as the bond buyers, which are mostly mutual fund houses. It also transfers the entire risk of the acquisition to the bond buyers in the process. Let's analyze Elon Musk's purchase of Twitter with this in mind. By selling Tesla shares, he removed $24 billion from his wallet. He raised $7 billion from his friends, Saudi Prince Alalaweed bin Talal and Larry Ellison, and then another $13 billion from 7 different banks. $6.5 billion of these $13 billion were spent by him on the leveraged buyout. The banks here have now attempted to sell Elon loans to smaller fund companies because they have exposed themselves to a significant risk. To simplify it for a layman, let's say Elon Musk received a $1 billion loan from one of these institutions. It then divided this loan into 10 units, each valued at $100 million, and it turned it into a bond. Next, a fixed return of $10 million was guaranteed. Therefore, the return over here is 10%. As a result, these banks could charge Elon a 15% interest rate while paying these buyers a 10% interest rate. They will eventually be able to maintain a 5% profit on a $1 billion debt without actually dispersing $1 billion in cash. This is awesome! The purchase has been completed, the risk has been allocated, and the banks can now reap significant gains. However, these hypothetical situations are only intended for an ideal market. There is a significant issue with Twitter. Elon made international headlines as soon as he began making changes and entered the picture. Large advertisers like GM, Volkswagen, and Audi pulled their ads from Twitter as a result of these radical adjustments. Selling blue ticks for $8 a month as part of Elon's plan to increase revenue didn't pan out. Every single day, the entire business was losing $4 million. The situation got worse when senior staff members left the business and numerous others were fired. As a result, smaller investors are no longer willing to purchase these bond units at all after seeing the state of Twitter, even though the banks were offering to pay $10 million in exchange for each bond unit they sold for $100 million. The only choice the banks had was to lower the price of this bond. They reduced it from $100 million to $90 million to $80 million to $70 million to just $60 million. However, since that is how the bonds function, the yield must continue to be the same $10 million. As a result, somebody who buys this unit at the current price of $60 million would receive a return of $10 million for an interest rate of 16.66%, given that they will only be able to collect $600 million from bonds. This casts serious doubt on the bank's ability to recover the full $1 billion loan amount. For every $1 billion lent to Elon Musk, a staggering $400 million of their cash are at risk. There are currently two options. One, the banks would suffer a loss by giving 16.66% interest to the investors if these loans were lent at fixed interest rate of, say, 15%. Second, the interest liability on Twitter could increase by up to 25% if the banks maintain a floating interest rate, i.e., couple the lending interest with the interest on their bond units. This implies that buyers will become skeptical if there is more bad news about Twitter. Bond units would become less expensive, and buyers would receive higher returns from the banks. This completes the vicious cycle because the banks will now charge Twitter higher interest rates. You can now picture the investors' skepticism before purchasing these junk bonds. Currently, the social media site is not completely doomed. If Musk's changes are successful, Twitter will turn a profit, pay off its debt, and the investors who purchase this debt will benefit greatly. However, if Twitter fails, it could set off a chain reaction that causes billions of dollars in losses for all the institutions, as well as a possible decline in the value of their stocks. Since the market is anticipating a slowdown, it will be a nightmare for Elon Musk and the American economy if any of these banks fail. A disaster in the US could unleash a global economic tsunami that would hit every nation's shores. With this, we wrap up this episode of Informed Investing. Do you believe that Twitter will succeed despite all of these worries? Or do you believe that it is doomed? Drop a line in the comments and let me know. Thanks for watching. Please subscribe to my channel and hit the like button if you enjoyed the video, so that you may be notified when I upload a new one.